It always starts the same way, with calm, no panic, no warning, just numbers that quietly begin to twist as if the system itself is trying to send a message. And today, that message is louder than ever, because right now, it's doing exactly that. It's not a scream that most people can hear. It's subtle, buried deep within the numbers, hidden beneath the optimism. But to those who understand what it means, the message is clear: danger is coming. There's a pattern that has appeared before nearly every major financial collapse in the past century. It flashed before the Great Depression, before the dot-com bubble, before the housing collapse of 2008. And today, it's flashing again, brighter and longer than ever before. That pattern is known as the yield curve inversion. On paper, it sounds technical, harmless even. But behind those words lies one of the most powerful and terrifying indicators in all of economics. Every time the yield curve has inverted, a recession has followed. Every time. And not just minor ones, catastrophic ones. But this time, the signal isn't just back. It's louder, deeper, and more distorted than ever before. What's coming might not just resemble 1929 or 2008. It could be far worse. Because our world today runs on far more debt, far more leverage, and far more illusion than at any point in history. The global economy is a house of cards built on confidence, and the yield curve is showing the first gusts of wind. To truly understand the meaning of the yield curve, we need to go back almost 100 years, to a time when optimism ruled the world. The late 1920s were an age of excess. Factories were booming, cities were glowing, and people were convinced that humanity had entered a permanent age of prosperity. The stock market was rising almost every week. Ordinary people who had never owned a share in their life began buying stocks on margin, using borrowed money to chase easy profits. Newspapers proclaimed a new era, one where crashes were impossible. But quietly, in the background, the numbers began to shift. In 1928, short-term interest rates suddenly climbed higher than long-term ones. That simple inversion might seem small, but it was massive. It meant investors were demanding more money to lend for a few months than for several years. In other words, the future looked safer than the present, and that never happens in a healthy economy. It was a sign that money was tightening, that liquidity was vanishing, that the financial system was bracing for impact. But the world ignored it. For nearly 2 years after the warning, stocks kept soaring. The Dow rose by almost 50% after the inversion began. The party continued. People told themselves it was different this time. But in 1929, the music stopped. Within months, the market collapsed. The Dow fell by 80%. Banks failed by the thousands. Millions lost their jobs and their homes. An entire generation was scarred by a crisis that, in hindsight, had been predicted all along by one silent line on a chart. Decades passed. The world rebuilt itself. People convinced themselves that they had learned from history. But patterns have a way of returning. At the turn of the millennium, the world was once again gripped by euphoria. The internet had arrived, and it was changing everything. Companies that had never made a profit were suddenly worth billions. Analysts said the old rules no longer applied. But in the year 2000, the yield curve inverted once again, and only months later, the dot-com bubble burst. Trillions of dollars of wealth evaporated. Investors who believed in a new economy watched their savings disappear overnight. Yet the lesson didn't last long. Only a few years later, in 2006, the yield curve flipped again. This time, the danger came from real estate. For years, easy credit had fueled a housing boom. People were taking out massive loans on homes they couldn't afford, believing prices could never go down. But once again, the yield curve warned that something was deeply wrong. Short-term rates rose higher than long-term ones. The message was clear, the system was under stress, and just like before, nobody wanted to listen. The market kept climbing, the economy looked strong, unemployment was low, and then it all collapsed. The housing market imploded, banks failed, global markets froze. By the end of 2008, the entire financial world was on its knees, and once again, the same silent signal had been right all along. Now here we are again. In August 2022, the yield curve inverted once more, but this time something extraordinary happened. The inversion didn't just appear, it stayed. It grew deeper, longer, and more severe than anything we've seen in modern history. It's now been inverted for well over a year, a duration unmatched since records began. And yet, on the surface, everything seems fine. The stock market is up, unemployment is low, headlines talk about soft landings and resilience. Economists point to strong data as proof that the system is safe. But history tells a different story. Every great collapse begins with calm. Every panic starts with confidence. The years before 1929 felt secure. The years before 2008 were filled with optimism. And today feels no different. The calm you see right now isn't stability, it's pressure, building quietly beneath the surface, waiting for release. In the past, yield curve inversions brought pain almost instantly. In 1973, when the curve flipped, recession followed within months. Oil prices exploded, consumers panicked, and the economy contracted violently. The same thing happened again in 1979. The moment the curve inverted, the downturn began. But this time, the reaction has been delayed. The question is, why? The answer lies in the aftershocks of the pandemic. When governments around the world printed and distributed trillions of dollars, consumers were left with record savings. In the US alone, more than $2.5 trillion of excess cash were sitting in bank accounts, a financial cushion that kept people spending long after the economy should have slowed. That money became a shield, protecting the illusion of strength. Businesses kept hiring, spending stayed high. It looked like the system had escaped gravity. But shields don't last forever. Those savings are now gone. Credit card balances have hit all-time highs. Delinquencies are rising. The cost of borrowing is suffocating small businesses. The invisible protection that delayed the recession is evaporating, and when it's gone, the real impact will begin. So what does the yield curve truly tell us? In simple terms, it's the relationship between short-term and long-term interest rates, a snapshot of how investors view time. Normally, investors demand higher returns for lending money long-term because the future is uncertain. But when the yield curve inverts, that logic reverses. Investors start demanding higher rates for lending short-term. It means they fear the immediate future more than the distant one. They'd rather lock their money away for 10 years than risk lending it for 6 months. That's how deep the anxiety runs. And the deeper that inversion goes, the more severe the pain that tends to follow. Throughout history, shallow inversions have been followed by mild recessions. Deep inversions have preceded major collapses. Today's inversion is one of the deepest ever recorded, a distortion so extreme that it's rewriting financial history. There's another reason why this time is different and far more dangerous. In 1929, household debt was minimal. In 2008, it was concentrated in housing. But today, it's everywhere. Mortgages, student loans, auto loans, credit cards, and record-breaking government deficits. The entire global economy is built on borrowed money. That means when the cost of borrowing rises and stays high, something must eventually break. A family that borrows too much eventually stops spending. A business that refinances at double the rate eventually cuts jobs. A government that spends more than it earns must print or default. It's not emotion, it's arithmetic. And the yield curve is the line that shows when the math stops working. This is the trap the world has built for itself, an economy that cannot function without constant borrowing, an illusion of wealth powered by credit cards, loans, and government deficits. But debt has limits, and once the cost of that debt becomes unbearable, the illusion begins to shatter. Some people point to the markets and say, "But stocks are going up. How can a crash be near?" That's the oldest misunderstanding in finance, because the market always rises before it falls. In 1928, stocks surged for almost 2 years after the inversion. In 2006, the same thing happened. The longer the delay, the greater the destruction that follows. That delay is psychological. When nothing happens right away, people feel safe. They believe the danger has passed. They borrow more, invest more, take on more risk. The false calm gives birth to the storm. That's where we are now, trapped in the illusion of strength. The economy appears solid because it hasn't yet broken, but pressure doesn't vanish. It builds. The longer it's ignored, the worse the break will be when it finally comes. The cracks are already visible for those who look closely. Corporate bankruptcies are rising quietly in the background. Consumer debt delinquencies are climbing fast. The cost of financing has doubled for small and medium-sized businesses. Many are holding on by a thread. And while governments proudly point to low unemployment numbers, the truth beneath the surface is darker. Full-time jobs are shrinking. Part-time and multiple job workers are increasing. People aren't earning more, they're working more just to stay afloat. It's the same pattern we saw before 2008, before 2000, and even before 1929. Strength on paper, weakness underneath. The calm you see now is not safety, it's silence before impact. When systems appear strongest, they are often closest to collapse. History never announces its turning points. It hides them in plain sight, among the numbers no one wants to read. What makes this era even more dangerous is how interconnected everything has become. In 1929, the crisis was largely national. In 2008, it was global. Today, it's planetary. Banks, governments, and corporations are tied together by a vast web of debt and derivatives. One failure in one corner of that web can send shockwaves across the entire system. A single major default, a sudden liquidity freeze, a geopolitical event, any one of these could trigger the chain reaction. The result wouldn't just be a market correction, it could be a complete restructuring of how global finance operates. The yield curve is already hinting at that future. It's not merely predicting a downturn, it's whispering that the entire structure is reaching its limits. We've built an economy so leveraged, so tightly wound, that it cannot absorb even small shocks without amplifying them into crises. When the next break occurs, it may not be contained within borders or markets. It may move through the digital veins of the global system within hours as algorithms and liquidity vanish together. The web that once made the world efficient has also made it fragile. If we trace history, we can see the rhythm. The 1928 inversion led to a crash about 17 months later. The 2006 inversion, 16 months later. If history rhymes, the danger window is now. The setup is hauntingly familiar: low unemployment, rising optimism, booming markets, and widespread denial. In every era, people said the same thing: it's different now. But the truth is, it never is. Technology changes, policies change, but human nature doesn't. The same greed, the same denial, the same arrogance repeat again and again. And when the breaking point comes, it never comes gently. It comes like an avalanche, sudden, violent, unstoppable. It wipes out confidence first, then value, then stability. By the time people realize what's happening, it's already too late. That is why every chart, every calm headline, every optimistic forecast feels so eerily familiar. The thunder is distant, but it's coming. What's coming is not just another recession. It's the unwinding of an entire era, a purge of excess, of debt, of blind confidence. It will shake governments, companies, and individuals who built their futures on the belief that growth could last forever. But every collapse brings rebirth. The Great Depression eventually built the modern financial system. The 2008 crisis reshaped global banking. Whatever comes next will change the world again. It will be painful, yes, but it will also clear away what was rotten and unsustainable. The yield curve is not crying wolf. It's warning us, just as it always has. It's saying the system has gone too far, that the pressure is reaching its limit, and that pretending otherwise won't stop what's coming. Every calm before a storm feels peaceful until the first thunder cracks. And when it does, people will say they never saw it coming, even though the signal was right there all along. The breaking point is rarely visible until hindsight. But this time, for those who pay attention, the clues are everywhere. This time, you can see it. You can feel it. The yield curve doesn't lie. What's coming won't just repeat history, it may rewrite it. And yet, almost nobody is talking about it. The silence is not ignorance, it's fear. Because acknowledging what's coming means admitting that the system we built might not be as strong as we thought. So before the storm hits, take a step back. Understand what's happening. Prepare. Don't be the one caught in denial when the system finally gives in. Awareness, not panic, is the difference between survival and shock. And if you want to learn how to build YouTube channels like this one and turn knowledge into income, I've opened a free Telegram community. The link is below. Smash that like and subscribe button if you want to stay informed. And remember, the deeper the silence, the louder the crash.